Welcome everyone. Today, we're going to break down one of the most practical topics you'll deal with, both in your exams and in your future careers: claiming employment expenses in Canada. Getting this right is absolutely essential, so let's make sure we've got it covered.
Just so you know, I've put this explainer together to really supplement our course material and give you a solid review of the key concepts you'll find in the CRA's T4044 guide.
So here's our roadmap. We'll start with the absolute basics, the fundamentals. Then we'll get into the different rules for salaried versus commission employees. We'll touch on some unique rules for specific jobs, and then we're going to spend a good chunk of time on the two biggest claims: your home office and your car. We'll wrap things up with the GST rebate and, of course, the all-important paperwork. Let's get started. Okay, first things first. Before you even start thinking about adding up receipts, there's a critical hurdle you have to clear. This applies to pretty much everyone.
This is the million-dollar question, isn't it? The ability to claim any of these expenses isn't just automatic. It all comes down to one single crucial document from your employer, a form that basically gives you the green light.
And here it is, Form T2200. Let me be perfectly clear about this. Without a signed T2200 from your employer, you can't claim these expenses. Full stop. Now, you don't actually file this form with your tax return, but you absolutely must have it. If the CRA ever comes knocking, that's the very first thing they're going to ask for.
All right, once you have that T2200, the path splits. The rules change quite a bit depending on how you're paid, whether you're a salaried employee or you earn commissions. This is a really common area of confusion, so let's unpack it. So the biggest difference here is the deduction limit. A salaried employee can claim specific costs, and there's no cap based on their income. But a commission employee gets to claim a wider variety of things, like advertising or promotion, but their claim is usually capped at the amount of commission they earned that year. Now, there are a couple of huge exceptions to that cap. Capital cost allowance and interest on your vehicle can actually be claimed even if they push you over your commission income.
Now this is a brilliant example of the strategy involved. Take a look at Andrew's situation. His commission is $5,000, but his expenses are way higher. If he claims as a commission employee, his main deductions get capped at that $5,000. But here's the cool part. He has a choice. By deciding to claim as a salaried employee instead, yeah, he loses the advertising deduction, but his much larger travel expense is no longer capped. And as you can see, that choice ends up giving him a bigger total deduction. It's a fantastic strategic point.
Okay, moving on. Outside of the general rules, the Income Tax Act actually has some special provisions carved out for certain jobs. If you happen to be in one of these fields, you get access to deductions that other people just don't.
This covers a few specific groups: transportation employees, artists, musicians, tradespeople, and forestry workers. For instance, long-haul truck drivers can use a simplified method to claim their meals, which is a huge help because it means they don't have to save every single little receipt from the road.
And for tradespeople, there's this specific deduction for new tools. The way it's calculated is pretty unique. You can deduct the amount you paid that's over a certain threshold, which is $1,433 for 2024, but the claim itself is capped at a maximum of $1,000. It's a really key benefit to help offset the high cost of their equipment.
All right, class, now we're getting into the two big ones. These are not only the most common claims, but they're also where things get the most complex: your home office and your vehicle. This is where you'll find the biggest deductions and, frankly, the most common mistakes.
So, to claim home office expenses, you have to meet one of these two conditions. The first one is the main place of work test. That just means more than half your work time is spent there. If not, you might still qualify under the second condition: you have a space used exclusively for work where you regularly meet clients. A classic mistake is someone thinking they can claim an office just because they bring work home in the evenings. Nope, that doesn't fly.
The calculation itself has to be reasonable, and it follows these steps. You start by figuring out the base percentage. Just divide your workspace area by your home's total finished area. But if that space is a shared area, like your dining room table, you have to do a second calculation. You have to prorate it based on the number of hours you actually use it for work.
Okay, let's switch gears to vehicles. This distinction right here is absolutely critical. A passenger vehicle, which is what most of us drive, like cars and SUVs, is subject to some really strict deduction limits. On the other hand, a motor vehicle, say a heavy-duty pickup truck used for a business, doesn't have those same limits. You've got to know which category your vehicle falls into right from the start.
Now this slide shows the leasing cost calculation for a passenger vehicle. And I know it looks complicated, but here's the deal.
you have to calculate two separate limits. You can see in Tom's case, limit 1 is almost $13,500, but then limit 2, which factors in the car's original price, comes out much lower, at $5,500. And the rule is simple. You have to claim the lower of the two, so Tom's deduction is capped at $5,500. So what if you buy the car instead of leasing it? Well, you can't just write off the whole purchase price in year 1. Instead, you claim something called capital cost allowance, or CCA. You can think of it as the tax version of depreciation, where you get to deduct a piece of the vehicle's cost every single year.
Which CCA class you use depends on the car's price tag before tax. For 2024, that magic number is $37,000. Anything more expensive gets put into Class 10.1. And this is a massive distinction, because Class 10.1 has a special rule. When you eventually sell that vehicle, you can't claim a terminal loss, and you don't have to report a recapture. Each of these luxury vehicles gets its own separate pool, unlike in Class 10 where they're all lumped together.
Next, let's talk about something that gets missed all the time. You've already deducted your expenses to lower your income tax, but what about all the GST or HST you paid on those same expenses? Well, there's a whole separate process to get that money back.
You claim this using Form GST 370. And let me be really clear, this is a rebate, not a deduction. A deduction just lowers your taxable income. A rebate is cash. It's a direct refund of the sales tax you paid. As long as your employer is a GST/HST registrant, you're probably eligible for this. You don't want to leave that money on the table.
And finally, proof. All these deductions we've talked about are worthless without the right paperwork to back them up. Remember, the burden of proof is always on you, the taxpayer. So keeping meticulous records isn't just a good idea, it's absolutely mandatory. Remember this number, 6. You have to keep all of your supporting documents, your receipts, your logbooks, that T2200 form, for 6 full years after the end of the tax year they relate to. The CRA can ask to see them at any point during that time, so make sure they're organized and you know where they are. Think of this as your audit-proofing toolkit. The signed T2200 is your permission slip. The receipts are your evidence. And for any vehicle claim, a detailed logbook is completely non-negotiable. I'm talking every trip, the date, the purpose, the kilometers. The CRA is incredibly strict about vehicle logs.
So what's the big picture here? The tax system allows you to deduct the legitimate costs of earning a living, but it demands that you be diligent and that you have proof. By really understanding these rules and keeping your records organized, you can make sure you're claiming every single dollar you are entitled to. Be thorough, be organized, and you can confidently lower your tax bill.